right, welcome back, everybody. And yep, it is St. Patrick's Day. So, thought we'd, there we go, it's on that side. Thought we'd give you a couple little shamrocks, a little green hat. Don't forget to have your green beer. I'm sure they're doing the St. Patty's Day Dash today, which I am not there. It is a stunning day. So, make sure that you get out, be safe, make sure that you're cleaning out your gutters. We have some cold and wet coming up, and we've had some winds, and so a lot of things were in people's gutters. Had a few of those yesterday. Nonetheless, let's talk a little bit about what the heck is going on. You know, you said, George, you said your title here says, hey, mortgage rates, they were on their way up, and this coming Wednesday, we've got a new Fed report because the Feds are meeting, and it could be catastrophic. And that is absolutely correct. Now, remember, I'm not a mortgage broker, but with our clients who help buy and sell real estate, they absolutely care about rates. So we keep a very much an eye on them. So here's the thing. Wednesday, the Feds are coming out with their report. Originally, they had talked about reducing rates through 2024 by 0.75 of a point, 75 basis points, or up to 100 basis points, which is 1 point or 1%. All right. Now, they originally talked about that in February, but because inflation, because CPI, because those numbers are not coming down, since the Feds actually want to be closer to 2%, and I think they're at 3.4, 3.6. The problem is they cannot reduce those commercial lending rates, because remember, Feds only affect commercial sides of things, not residential loans. They do have an effect, but we will see what happens. Like this last week, we had technically some modest numbers, but the bonds didn't like it, and so rates actually went from 6.7, 6.8, up to 7, came back down a little bit, went back up again, and we're going to see what shakes out on Wednesday, because if you're on the fence right now about, oh, do I lock my rate? Do I lock my rate? Do I lock my rate? You may, unless you're willing to do the lost wages or Las Vegas roll of the dice, red or black, Wednesday could either be super beneficial or catastrophic. So remember that, keep that in mind. If you are risk averse, you may want to consider a different path. Oh, the disclaimer, that is my humble and personal opinion. That is not a professional opinion. You should not rely on that opinion except for what it is valued at. Some people say it's worth a shiny dime, and we'll see, right? Anyway, moving on. Let's open this up. We take a look at this. This week witnessed turbulence bond yields. That's what we just described. And we're talking about as far as the CPI or the Producers Price Index, the PPI, which didn't do so well with what numbers the Feds were truly looking at. All right. This Wednesday, again, keep that in mind. If you're on the edge, sometimes it's better to be safe than sorry. Just saying. All right, let's pop this back up. We take a look at our market watch, our 7-day running average, residential only, okay? You can see that we have 1,062 homes that came on market, and we had 1,287 that went pended, along with 768 that actually closed. Now, those numbers are doing really well, but here's the important thing. If you've been watching this every week, you'll know that, hey, we keep dropping inventory. We are seeing more pended than homes that are coming on market. That is an important trend because there's a lot of buyers out there that are being very aggressive. In fact, yesterday we were out with clients most of the day, and there was some craziness going on, including some sellers with some pretty aggressive pricing. We will see how that shakes out. Some of them, I think they're just too far on the other side because buyers are super smart. And remember, the first impression of your home is price. It's not street appeal. It's not even the really beautiful pictures that you may or may not take. It's price. They will make go or no-go decision based on price. So keep that in mind. All right, moving on. So when we get over, don't forget, like, subscribe, and share this. This is super accurate information. We have a very high level of accuracy consistently. All right, let's take a look at Freddie. Freddie today on their running day average, 6.74. It's actually a little bit higher because that's an average of the last 7 days. But you can still see that we're still heading in a very good trend as far as even in Freddie, where, you know, we've been coming down since last year. And when we take a look at, you know, hey, what the heck is going on? What should we be doing, you know, as far as making ourselves better in the eyes of the lender? Look, watch the video that talks about things you should do, because credit score is directly proportional to your rate. All right. Because remember, rate in lending is risk-based. If you're a bad risk, you're going to have a higher rate. If you're a low risk, you're going to have a better rate. So do those small things that help you get a better rate. If you need some lender referrals, hey, we'll send you 3 of them. They share the same professional and ethical standards we do. They're absolutely awesome people. And if you ask them to lose your number, they do. That's the super cool part. When we take a look at our headlines for today, in the beginning it says, look, rate drops prompt the refi application volume. That cracks me up because down below it says, hey, man, we bounced back up to the 7s. However, on the right, should I refinance? That's one of the calculators that is available to you. It is free. Some folks that are at the higher rate, they're like, oh, is it a good time to refi? I'm like, look, hey, take your payment, take, you know, everything you've got, plug it into that calculator, and it will tell you. Historically, you need 3/4 of a point or 0.75% difference in rate to make it really beneficial. We'll see. Do the calculator. It's easier. All right. It takes the guessing game out of it. Take a look at this. This is a case in point. So home prices hit all-time high, leading apartment and renters to favor long-term leases. And we are absolutely seeing that. In fact, what's super interesting, a number of our clients who have multifamily, different rental properties and whatnot, you know, they are looking at pretty solid numbers, all things considered. Because you see, here's the thing. A lot of folks said, hey, you know, rates are going to go up and home values are going to drop. In fact, one investor that I was chatting to, or a home buyer, it was one of the two. They said, oh, George, you know, rates are going to double and real estate's going to drop 50%. And that is when I'm going to buy a home. And I looked at him and I went, what? At that point, the rates were, 3.5%, 4%. They said, oh yeah, when they go to 7%, real estate is going to crash. And I said, no, it's not. Yeah, we don't have enough inventory. A, B, these are artificially kept down. People will acclimate to that. I almost guarantee that. Well, guess what? We've been there for almost 1.5 years, 2 years, and real estate values have actually continued in an upward trend. Will they continue that way? As long as our employment and business, as long as the state doesn't continue their craziness, will continue to improve. Inventory stays, at a lower level. We will always have a stable, inventory or value of homes. Why? Because people know that investing in homes is still a solid environment. We're not looking at the foreclosure rates like we did in 2000 and 2008, 2009 through 11. Commercial, however, they're going to take a little bit of a beating. But remember, the people or the areas that were suspect to be in danger, Tennessee, Florida, Texas, Michigan, Pennsylvania, they're not even near us. We got a lot of territory before they get to us. We'll go over that a little bit later. All right, let's get back on track. All right, when we take a look at what's been going on just as the average price of homes today versus the average sold price. Look, last week we were at a minus, meaning it was, the price went down, which our median sales for our active home was $1.8 million. We're up to $1.17 million, so we've improved that a little bit. But look at that. When we talk about the average sold price, last week, we were at about 8.7. We're at 8.8 this week, meaning that last week the average sold price was 789. We're at 794 last year at this time. We were at 730,000. Why is that important? That is super important because we are seeing that spring market. We're seeing that seasonally normal and very aggressive buyers out there. And yes, we are seeing multiple offers. And yes, we're seeing escalations, not insane escalations, but still escalations nonetheless. And as people are continuing to add more homes, meaning sellers coming on market, which has been sparse, we'll continue to see what that hammers out. But I'll tell you, if you're on the fence, take a look at this. Super cool. Last year, we had basically 6,865 homes. We've got 6,749 available today. That, my friends, is half of where it should be. Half. Okay. Look, when we take a look at it year over year, we're only 514 homes off from where we were at last year. And, you know, we're only 57 homes off from the pendant. But for the month of March, which is the middle of March now, you know, we are actually up almost 11% when it comes to pendant sales. This is important because it's showing you clearly we are taking, again, more inventory off. And look, we should have 12,000 homes. We don't. We have 6,000 and change. That's half. Anyway, just saying. Market continues to go. We still have a scarcity of inventory issue, not a supply and demand. I think the demand and the supply are pretty close to each other, and that is consistent here. Otherwise, if we had a greater demand, we would be down in the 4,000 home mark. So I think our balance, supply and demand, and notice I say inventory, not supply and demand, two different things altogether. I think our demand is about spot on. So for sellers, don't be stupid. Price is your first impression. Keep that in mind. And it will, the market will be very clear as to where your home is valued in the eyes of the buyer, because the buyers are the price makers. Okay? You're a price taker as a seller. Keep that in mind. All right. Moving on. Here we go. Let's take a look at new construction. New construction, again, even though we look at it year over year for the same month of March, you know, we're down about 158 homes, down, 21 homes for pendant. Year over year, we're down a little bit. We had a pretty aggressive March last year, and we're still seeing just phenomenal activity this year. New construction is absolutely, without a doubt, very solid. We're still seeing builders tying up projects. We have a couple of them, working with builders and projects right now to get those ramped up and through the process. And why? Because they're still seeing that there is a massive demand of buyers out there. And even though they're offering different incentives, they're maintaining plat quality and plat pricing. With that, they're able to take away with their incentives. They just take you away from sellers that aren't offering some form of incentive or making sure that their first impression, which is price, is a little bit more desirable for them to go and look at. Look, most existing homes are better than new construction, except for in the event that new construction is new. Nobody's been in it, right? But the lots are smaller, they're a lot tighter, communities are tighter. The existing homes, for the most part, have bigger lots. They've got better community. I shouldn't say better communities, but you just get a little bit more, especially if you're looking at homes that are a little bit older, where you actually have a piece of property. We looked at things yesterday at 9,600 square foot lots, and people were like, wow, there's a lot to mow. And of course, they start laughing because they've been looking at things between 3,000 and 4,000 square foot. And, you get that little patch of grass or whatnot. Anyway, just keep that in mind. New construction, absolutely killing it. But next slide, we talk about foreclosures and REOs and bank owned. Look at this. Those numbers look almost scary. When you see that, it says, hey, our inventory's up, 24%, but oh my gosh, look, pendant are up 100%, 41.7% for pendant, as far as the same month, year over year. And you're like, holy smokes. Okay, when you're dealing with little tiny numbers, those numbers, and I can tell you that 10 of those are not bank-owned homes. They are seller, homeowner owned. Their agents just are doing them a disservice. But anyway, to keep it clean, not to clutter up the chart, we just left it the way it was. Here's the thing. When you double a tiny little number, of course it looks big. That is 3/4 of Washington state. That is peanuts. That is nothing. Now, we have seen an increase. Of course we have. Why? Well, because since 2020, there's been the CARES Act. And the CARES Act did not allow banks to foreclose homes. Why? Well, because of the beer issue that was out there, because we can't mention the name of that because they kicked me off. So the beer issue that we had that starts with a C. Anyway, they, right, decided that the good idea was, hey, let's not do that. And that didn't end until March of last year. So of course we're going to see an increase in foreclosure activity. Of course. What did you think? So when you take a look at that, and now that has been a year since it was the end of March last year, since it's been a year, okay, now we're starting to see a little bit more activity, but we're not seeing like, hundreds of thousands or even thousands or even hundreds of foreclosures happening. Not at all. So in that regard, foreclosures are not a great investment. Banks go out, they mark them paint, carpet, and vinyl, put them at market value, which is awesome because then it mitigates their loss. The ones, if you're looking at wanting to follow foreclosures, follow commercial, right? Whether it's commercial Class A, B buildings, multifamily, commercial vacant land development, things like that where, they have to do their 5 or 7 year refinance, where they're at, 7, 8, 9%, whereas before they were, 3, 4, 5%, somewhere in there. Understand that is the industry that's going to get hurt. And yes, there will and be expecting banks to fail. Hands down. Why? If the feds do not drop their rates, which affects commercial lending, and the banks become insolvent because of the commercial loans that they have, they're going to fail. It's a given. Now, will that translate into residential real estate side? Probably a little bit. I don't expect a whole lot. It is going to be more commercial fallout than anything else, but we'll see what shakes out, and we'll see what some of the bigger banks decide to do and what the feds decide to do. There we go. All right. Now, let's get back to it. We come over here and we pop into the like, subscribe, and share. Had to give myself one last plug there. Look, if you like the information, do us a solid. Give us a big thumbs up. Subscribe to the channel. It's free. There's no marketing here. It's all solid information so you make the best business decision for you and your family. In the meantime, after you subscribe and smash that subscribe button, you guys have a beautiful day. I'll see you on the next video. Take care.